Welcome back to the fifth lecture in the fourth module, Valuation of Equity Share. In this, we would be discussing about the comparative valuation ratios. So it would be a summing up of the previous four lectures plus certain other ratios which is part of the income statement valuation which is to be used. So here we will be discussing about the introduction to valuation ratios, then what are the other ratios which we have used in terms of P ratio, value, enterprise value to EBITDA, and the advantages and disadvantages of it. I have not dealt with in detail in the about the ratios which we have already seen in the previous lecture, but just a brief outline so that I can have a continuation into the next part. So, what does valuation ratios mean actually? Valuation ratios is nothing but it is a matrix. It's a financial matrix to help the investors for what? For taking a decision about the company's stock. So, how do they do this? They are going to do this by comparing it the market price with the book price or financial performance with the actual performance of the company. So, valuation ratios is nothing but it is a matrix which is used by investors which is derived from the company's fundamental performance and its comparison with the market prices based upon the company's to find out the value of the company's stock. So, that is what you mean by valuation ratios. And under most of the situations, valuation ratios are used to find out how the stock is performing in the market and whether it is overpriced, underpriced or fairly priced. And this is considered to be a very simple way of looking at the performance of a company just by looking into the earnings of the company. Okay. So, I am just considering one factor over here, and based on this I am trying to see its impact on the market and I try to take a decision. So, that is in a nutshell whatever is mentioned over here is telling this particular factor over there. And this is commonly used for equity valuation because that is the most common way of investing in any of the firm. Why comparative valuation ratios are used? It is because investors need to identify where they have to put their money. So, they have a direct option to make a comparison between companies or between industries. If they have to choose an industry based on the industry average, they can take a decision, and if they have to identify companies within an industry, they can use the valuation ratios as a basis to identify the performance of that particular company and determine whether the money should be invested in that particular stock or not. And by analyzing these ratios, the investors would help in telling the potential investors that this is considered to be the growing firm by actually creating a market sentiment being created over there. So, this ratios can also help to identify the stocks by the potential investors through market sentiments, and that is explained over here. If there are two companies and within the same industry and they both have two different PE ratio, which would you select? You would be selecting those which has a higher PE ratio. So, if suppose there is a difference in the PE ratio, it could be because of the expectations which is prevailing in the market among the investors. It could be because of the different risk level at which the companies are functioning, or it could be because of the potential market mispricing which is happening. So, potential market mispricing is because of the sentiment factor driven. This is a sentiment factor driven activity which is there. So it is easier for us to make this comparison, and that is what is told, that it is relative to peers. So I'm using a PE ratio and I'm comparing the PE ratio of one company to another company which is within the same industry and saying whether it is good or bad. So it talks about a value decision based upon the valuation ratios. There are various types of valuation ratios. One which we have already discussed, that is price to earnings ratio, that is nothing but PE ratio. So here what we are doing is we are trying to compare the company's stock price to its earnings. Okay, and based on that you are telling that the investors are ready to pay this much amount for the earnings the company has made. So that is what price earnings ratio is talking about. Next type of valuation ratio you have is price to book ratio. So price to book ratio, it talks about your stock price in comparison to the book value per share. Okay, so book value per share is normally dependent on the net assets, company's net assets, or otherwise I can call this as the intrinsic value of share. So book value to share, price to book is nothing but the market price which you are ready to offer in comparison to the intrinsic value per share. So the higher price would be paid for those companies which is having a potential for growth in future. So such companies would be identified. The next type of ratio is price to sales. So here the stock price is determined based on the revenue per share, and it is often useful for valuing the companies which are highly volatile or is having negative earnings. So here the sales is considered as one of the factor which is going to have an impact on the market price of the share. So based on the revenue which the company is generating, the market price is determined. And this type of valuation is mostly found in companies which are highly volatile or which is having negative growth potential or negative earning potential. The next one is again an important valuation method which is called the enterprise value to EBITDA. So this compares the company's enterprise value to its earning before interest, tax, depreciation and amortization. And any valuation which shows lesser impact is going to have an impact on the capital structure. So the lesser valuation impact is in this particular ratio I am talking about when the earnings enterprise value and the EBITDA is negative or it is less than 1, then it is considered that it is not a good firm in which you can invest in, right? So it's important for us to understand that the enterprise value is determined based upon the actual functioning of the company in terms of its earnings. And here, when we are talking about earnings, we are not taking into consideration the interest paid, we are not taking into consideration the tax, depreciation and amortization. So this is the actual earnings which the company is generated and how it is having an impact on the value of this particular company. So this valuation is more important to have an impact on capital structure of the company. So let us take a look into all these different categories. This we have already seen in the previous lecture, but still just to have a revision. PE ratio is nothing but the market price per share upon earnings per share. Market price per share is nothing but the current trading price of the share, and earning per share is nothing but the net earnings divided by the total number of equity shares outstanding. So that is the formula for price earnings ratio, and its interpretation is a high price earnings ratio. It is always considered that it is good because investors expect a higher growth in future, and higher growth companies will normally be having a high PE ratio, and these are companies which are involved in either technology, biotech, or anything of that sort, pharmaceuticals. All these would be having a high PE ratio because they are considered to be high growth companies. A low PE ratio is because of a lower expectation by the investors because of the earnings which the company has generated, or it could be an undervaluation of the stock as such. So there could be two reasons. One, the expectation could be lower. The second, the undervaluation of stock. So if it is lower expectation, then automatically there are chances that the earnings will also come down. But if the market is undervalued, it can make a course correction in time to come, which will be reflected in later quarters. So there's no problem with that. The second type of valuation ratio is enterprise value to EBITDA, which is having importance. What does this actually say? It talks about the company's enterprise value to the earnings before depreciation, amortization, interest, and tax. Okay, and how is this particular ratio being used? It is used by investors to understand the relative value of a company. Okay, and how do they understand the relative value of a company? Why do they require to find the relative value of a company? Because identify the firm in which they want to put their money in. If suppose it deals with capital intensive industries, or it could be in certain cases where different capital structures are prevailing, you can use this particular ratio because of the difference in the proportion of equity preference and debt proportion in the overall capital structure. So this is the formula, EV upon EBITDA. EV represents the total value of the firm. It includes market capitalization, it includes debt, and it also includes any preference share which is part of the shareholding of the company, less the cash. Okay, and it reflects the entire value of the business which is being purchased. So normally this is taken into consideration. The enterprise value to EBITDA is taken into consideration in case of either acquisition or merger or anything of that sort. So how do we calculate enterprise value? Enterprise value is market capitalization plus total debt plus preferred capital minus cash and cash equivalents. So let us take each one of them. So let us look at the formula for EV. It says that market capitalization plus total debt plus preferred equity minus cash and cash equivalents. So market capitalization is nothing but the market price per share into number of equity shares outstanding. Okay, so you have a value for this plus debt. Okay, so it could be in the form of debentures or long-term debt, whatever it is. Then you have preference share capital. So it is another type of equity which you have. So these three put together is the value of your equity share, value of your preference share, total value of your debt, okay, minus the cash and cash equivalents. So cash and cash equivalents This could be short-term investment which the company has made in another company or anything of that sort. So it could be short-term in nature. So we are not going to take into consideration this aspect over here. Now the second part of the equation talks about EBITDA. EBITDA is nothing but the full form is earnings before interest, tax, depreciation and amortization. What does it actually show? It shows the company's operating performance and the cash generation capability of the firm. Okay. So basically the operating performance of the company is a depiction of from where the cash is coming in, what are the type of finances which you have taken, and what is the effect of these financing on taxes, and what are the non-cash expenses. All these are taken into consideration when I am talking about the operating performance. So here you should understand one thing, that whenever revenue is generated, sales is generated. So this sales generation is sales revenue includes total cost which the company incurs to manufacture the product plus the margin, profit margin. Okay. Now, if I want to calculate what is this, then I am going into this particular portion where I am talking about profit margin. If suppose I have kept 20% as the profit margin, then I have a clear definition as to how the proportion is divided. Okay. So 20 percentage of this profit margin, how much percentage is going to be affected because of depreciation? How much percentage is going to be affected because of the tax portion of it? How much it is going to have an effect because of the non-cash expenses, etc. So it could be in terms of wastages and other things. So most of the things are shown over here. So this particular measure to find out the value of a share is considered to be used for comparison between different companies with different tax rates, depreciation rates and interest structures. So it is not necessary that almost all the companies which capital structure will have the same EBITDA. There could be a difference in EBITDA because of the change in the interest rate, the change in the capital structure, the amount of loan which they have taken, and the depreciation on the machinery and other things which is to be levied upon. If suppose it is a capital intensive industry, then depreciation rate would be faster in comparison to the other. So it may have an influence on all these aspects. So going into the interpretation of enterprise value to EBITDA, low ratio, it normally indicates that the equity is undervalued. So undervalued, there should be a benchmark, right? So it is undervalued to its competitors, okay, and or the company has a very strong earning relative to enterprise value. So there are two ways you can have a low EV. If suppose this is very high, if this is very high, it means to say that the company's earnings is very high, but it is not reflected in the enterprise value. The second case is when this is lower in comparison to the enterprise value. So it means an undervaluation in comparison to the competitors. A high EBITDA, it suggests that it is you are paying more than what you should be paying based on the earnings as one of the parameters. So that's overvalued shares are mentioned over here. And this can also happen if it is a high growth firm, as I told you in the case of this. If the higher value would be based because of its superiority in terms of technology, in terms of the emerging market and the sentiments which is prevailing in the market, which might have driven the value of the stock above the actual thing. Coming to the advantages of this particular ratio, it accounts for the debt and cash because when we were calculating the EV, you might have taken care of the fact that we have excluded cash from the overall thing. So it takes into consideration the debt portion in the overall capital structure of the firm, and you are deducting the cash portion of it so that it gives a better comprehensive measure of the value in terms of the market capitalization or the value which the market has determined. Second advantage is it is useful for capital intensive industries. So capital intensive industries where the fixed cost is going to be very high and depreciation is going to play a very important role in such industries. This is considered to be a good way of measuring it because often these has volatile earnings involved in it. Okay. And the third advantage what you have is it is comparable across different capital structures because the EV part takes into consideration all the three things at the market price of equity shares. You have considered the preference shares, you have considered the debentures, you have considered the debt instrument, term debt, and excluding the cash portion, and the total earnings before providing for any expenses, which is in real term is not an expense. So it is comparable for different capital structures as well as different companies within a particular industry. The limitations of this is it ignores capital expenditure because when I'm taking the EBITDA, it excludes the capital expenditure, but this is going to have a significant portion in capital intensive business. So that's one of the drawback of it because it may not reflect a true picture of the expenses which the company is incurring in terms of capital expenditure. Okay, so this would make this particular ratio would make it less reflective of the actual cash flow which is happening in the market. And the next limitation is it doesn't account for the profit margins. Why? Because we have not considered the profit margin alone. We have considered the whole of the earnings without considering depreciation or amortization or interest which we have to pay for the debts which we have taken. So this is not the actual profitability and may not be a true representation of the whole thing. So might be in certain case this factor is very high. In that case, the company could be undervalued in that case. So there are chances like that to happen as well. And the third one is it can actually mask the financial distress. Masking financial distress is certain things are not evident in the way it should be evident. Sometimes what happens is you may have a high level of debt, but still you will have a good EV to EBITDA ratio. So this can lead to a positive sentiment for the stock, but in real terms, the enterprise value is not as high as expected. So it can lead to financial risk. When I supposed to use this particular ratio, this is supposed to be used when I'm talking about mergers and acquisition. That is, in case of either selling a company, I want to evaluate the value of the company at which it has to be purchased or sold. For that purpose, I'm going to use this particular ratio. It can be used for comparing firms in high debt industries as well as capital intensive industries. So both can use this particular ratio because this will help the companies to often carry large debts as it will neutralize the effect of different capital structure. So that's another way of manipulating the financial books. So that's a good way of doing it because high debt industries have to survive and enterprise values can be high even by taking a larger debt. The next important use is to assess the operational efficiency. So your denominator is going to measure the operational efficiency, and the higher it is, the value of enterprise will come down. The lower it is, the value of enterprise will go up. So you can find out whether the organization in which you are going to invest your money is going to generate income or whether it is going to be loss in the long run. So the enterprise values can have these things into the picture. So there's a comparative analysis of ratios. This is another method which is used in calculating the value of equity share, and it is normally used for financial analysis to assess the and compare the performance of company related to each other or to bring about a industry benchmark. And it can also be used for calculating the various financial ratios and comparing them with their counterparts in the market. It can help the investors, managers, and the analyst to find out the company's strengths and weaknesses in the competitive environment. And sometimes it can also be used for the various ratios which is being used for these calculations are liquidity ratios, which I think I have discussed in the fundamental analysis portion. Here you have current ratio which talks about short-term obligations. So all the liquidity ratios are going to talk about short-term obligation. So current ratio is nothing but current asset upon current liability. So it is a broader aspect. You are narrowing it down. So you have quick asset upon current liability where I am deducting the inventory portion from the current asset. So that becomes quick asset. So what does this say? It says that how you are comparing yourself with your competitors to find out how your short-term performance is. Next set of ratios is profitability ratios, which is part of your income statement. You have gross profit margin ratio, which I have already discussed in the fundamental analysis. Okay, so this talks about the percentage of revenue over and above the cost of goods sold. Okay, and it talks about the efficiency of production. So the revenue over and above the cost of goods sold is gross profit margin. Operating profit margin, it's nothing but the percentage of revenue left after paying the variable cost of production. So in other words, after deducting the operating part of the production activity, whatever is left out is considered to be your operating profit margin. And net profit margin is you are considering all the remaining expenses which you have incurred and find out the actual profit of the organization. So what does this say? This talks about the company's ability to generate profit in comparison to its competitors and also the operational efficiency of the management of the organization. You have efficiency ratio. In efficiency ratio, you have inventory turnover. It talks about how fast you are able to convert your inventory into sales. You have accounts receivable turnover. You are trying to find out how fast the company is able to collect money from its customers to whom you have sold goods on credit, right? So a high turnover ratio is always going to say that it's going to be effective management. You have valuation ratio, which we have already seen. which we have talked over here, and this is actually talking about how the investors is going to determine a company's actual value which they are ready to pay in comparison to its competitors. So this may be driven either by market sentiment or based on growth potential. The other ratios is earnings per share. I'm not touching upon it. We have already discussed. Dividend yield is nothing but the return you are going to get on each unit of share which you have purchased. Okay, and what does it say? So the higher the earnings per share or dividend yield, it is always better because the company is said to be progressive in terms of its profitability and other aspects. And for what purpose? It is used to make a comparison among companies to find out where the amount money has to be invested in equity and other things, which would be gaining or losing ground in terms of invested amount. It also talks about the strength of different organization in terms of cost control, in terms of profitability, and in terms of market valuation. And this form of analysis is important in terms of decision making for investment as well as strategic planning. If suppose it is mergers and acquisition, then because this plays an important role in positioning yourself in the overall marketplace. So if your decision goes wrong, then probably you are dead at the end of the day if you're going in for merger or acquisition with a miscalculated thing. So in this particular lecture, I have tried to discuss the remaining valuation ratios or valuation methods which is available to calculate the value of an equity share, how it has to be used, and how you can use this for making a comparison between the stock you have identified to be invested in comparison to its competitors, and how to make profit based upon the functioning and efficiency of the management and product of the organization. Thank you.